$55,000 a year in retirement, £0 in tax. That's not a clickbait headline. It's what I helped a couple achieve last year using strategies that are available to anyone, but that almost nobody uses properly. I'm going to walk you through exactly how we did it, layer by layer, and by the end you'll understand the single most overlooked pension withdrawal strategy in the UK, one that could save you tens of thousands of pounds over the course of your retirement. If you're new here, my name's Sanjay, I'm a chartered wealth manager, and this channel is about helping you make smarter retirement decisions. If you've watched my other videos on this channel, you'll know that I talk a lot about why chasing the highest return is the wrong game in retirement, and why knowing what you actually need matters more than maximising what you get. Today, I want to get practical, because how you take money out of your pension is just as important as how much you've put in, and most people get this bit wrong. When most people retire, the first thing they do with their pension is take the 25% tax-free lump sum out. It feels like free money. 300,000 pension? Great. 75,000 in your bank account. No tax? Lovely. But think about what that actually does. You've just used up your entire tax-free allowance in one go. From this point on, every penny you take out of your pension is taxable. The first 12,500 will be covered by your personal allowance, so that's fine. But everything above that, you're paying 20%. And if you draw more than £50,270, you're into 40%. So that 75,000 felt like a windfall. But in exchange, you've locked yourself into paying income tax on every future withdrawal for the rest of your retirement. For most people, that adds up to far more than 75,000 over 20 or 30 years. There's a better way. It's called a UFPLS. It stands for Uncrystallised Funds Pension Lump Sum. It's a terrible name, but it's a brilliant strategy. Here's how it works. Instead of taking your 25% tax-free lump sum up front and then drawing taxable income, you take small withdrawals from your pension where each withdrawal is 25% tax-free and 75% taxable. You take the tax-free element bit by bit, spread across your retirement, rather than all at once. And this is the bit that matters. If you withdraw exactly £16,760 per year, watch what happens. 25% of 16,760 is 4,190. That's your tax-free portion. Gone. No tax. The remaining 75% is 12,570, and that number should look familiar. It's exactly the personal allowance, the amount of income you can receive each year before you pay any tax at all. So the taxable part of your withdrawal lands perfectly within your personal allowance. Tax on that? Zero. £16,760 from your pension, £0 in tax every single year. And if you're a couple, you can both do this. £16,760 each. That's £33,520 per year from your pensions, completely tax-free. Not because of some loophole, not because of clever accounting, just because you're using two allowances, your tax-free cash and your personal allowance, together in the right order. Most people use one and waste the other. This uses both every year for as long as you have uncrystallised pension funds. I want to show you how this works in practice. I worked with a couple last year, let's call them David and Rachel. David was 60, recently retired, and Rachel was 63, not working. Between them, they had David's pension, £300,000, Rachel's pension, £50,000. ISAs worth about £80,000 combined. £30,000 in cash savings, and a general investment account, which is just a taxable investment account, worth around £60,000. Their goal? £55,000 a year in retirement with minimal tax. When they first said it, they weren't sure if it was possible. It is, and I'll show you how we built it. David takes £16,760 from his pension via UFPLS. Rachel does the same. £33,520 lands in their bank account. Tax paid? Zero. This is the foundation, and for a lot of couples with decent pension pots, This alone covers a big chunk of their retirement spending. David and Rachel have $30,000 in cash savings. At 5% interest, that's £1,500 a year. Split between them, that's $750 each. There are two allowances that protect this. First, the personal savings allowance. As non-taxpayers or basic rate taxpayers, they can each earn up to £1,000 of savings interest tax-free. So £750 each is well within that. But there's a second, lesser known allowance called the starting rate for savings. If your non-savings income, things like pension income and salary, doesn't exceed your personal allowance, you get up to an extra $5,000 of savings income tax-free. Because the UFPLS is designed so the taxable portion lands exactly on the personal allowance, David and Rachel therefore qualify for this in full. That means they could each earn up to $6,000 of savings income before paying a penny of tax. They're earning $750 each, nowhere near the limit. So the tax on savings interest is zero. ISAs are completely tax-free. No income tax, no capital gains tax, no reporting. You take out what you need. David and Rachel withdraw $12,000 from their ISAs. Tax, zero. Now you might ask, why not take more from the ISAs and skip the other layers? Because ISAs are the most tax efficient wrapper you have. Every pound you take out is a pound that's no longer growing tax-free. So you want to preserve them for as long as possible and draw from the other sources first. They still need another $8,000 to hit their target. This comes from their general investment account, the taxable one. So two things happen here. First, their investments generate some natural income. Dividends from the equity portion, bond interest from the fixed income side. In their case, it's about £1,800 a year combined. The dividends, roughly $700, are covered by the £500 allowance each. The bond interest, about £1,100, is savings income, which falls within that starting rate band we already talked about. So the tax is zero. Second, they sell £6,000 of the investments from the account. Some of that is their original money coming back. Some of it is growth. The growth portion, which is about £1,000, is a capital gain. Split between them, that's £500 each. The annual capital gains exemption is $3,000 per person. They're well within that. Tax, zero. So there it is. David and Rachel are drawing just over $50,000 a year. They haven't paid a penny in tax. And this isn't a one-year trick. It's sustainable. They're drawing about 4% of their total portfolio, which, as we discussed in earlier videos, is a reasonable withdrawal rate. When Rachel's state pension kicks in at 66, her state pension is going to cover part of her personal allowance, so we just need to adjust the UFPLS amount downwards. The plan flexes. The tax stays at zero or very close to it. Now I want to be upfront. David and Rachel's situation won't be identical to yours. The numbers are specific to them. But the strategies, the UFPLS approach, the layered use of allowances, the order in which you draw from your different accounts, those apply to almost everyone with a pension pot and a bit of planning. So if this is so effective, why doesn't everyone do it? 3 reasons. 1, they've never heard of UFPLS. Most pension providers don't advertise it. Most people may not know the option exists. They see take your tax-free cash on the website, click the button, and it's gone. 2, they don't plan their withdrawals across multiple accounts. They draw everything from one place, usually their pension, and overshoot their personal allowance. Once you're paying 20% on every pound above $12,570, it adds up fast. 3, nobody has sat down with them and worked out what they actually need. If you don't know your number, what $55,000 means for your life, whether it's enough, whether it's too much, you can't design an income strategy around it. You're just pulling money out and hoping for the best. And the cost of getting this wrong isn't small. A researcher called Reichenstein studied the impact of tax-efficient withdrawal sequencing on retirement outcomes. His findings? Drawing from the right accounts in the right order can add up to 7 years of portfolio longevity. Not 7% more money, 7 more years before your pot runs out. Separately, Blanket, Fink and Fow, three of the most respected names in retirement research, published a paper quantifying the total value of smart financial planning decisions, tax-efficient withdrawals, sensible asset allocation, and dynamic spending. They found that the combined effect was equivalent to roughly 1.82% per year in additional returns. They call it gamma. And none of that is investment performance. It's just the value of making better decisions with the money you already have. Put that in David and Rachel's terms. If they'd done the standard thing, taken 25% lump sum and drawn the rest as taxable pension income, they'd have been paying roughly $5,000 a year in unnecessary tax. Over 10 years, that's close to £50,000. That's a full extra year of retirement income given away just by drawing from the wrong place in the wrong order. This is where the how much is enough question from earlier in the series comes full circle. Tax planning in retirement and life planning aren't two different things. They're one thing. Once you know what your life costs, you can engineer the most efficient way to pay for it. One last thing, because this trips people up. You saw with David and Rachel that we drew from multiple accounts in the same year. Pension, savings, ISA, GIA, all at once. That's how you use all of your allowances. You need to pull from different pots to stay within each tax band. But there's a separate question. Which pot do you run down first? Which one do you deplete? Because over time, you're going to empty some of those accounts. And the order you do that in makes a big difference. The general principle is this. Your GIA, the taxable investment account, is the least tax efficient wrapper you have. So that's the one that you would want to shrink first. Sell from the GIA and reinvest some of it into the ISAs and pensions along the way. You're moving money from a less efficient wrapper into a more efficient one. Your ISAs, you want to preserve for as long as you can. Every pound left in an ISA is growing completely free of tax. So draw from them when you need to, but don't drain them too early. Your pension, you want to leave last. Not because you won't touch it, you'll use the UFPLS to fill your personal allowance every year, but you don't want to be draining the pot faster than you need to. The longer pension money stays invested, the longer it grows inside a tax-free wrapper. And if you don't need it all in your lifetime, pensions can pass to your family more tax efficiently than most other assets. Most people do the opposite. They hit the pension first because it's the biggest pot. That's usually the most expensive decision they could make. So now you know how to take income from your pension without paying unnecessary tax. You understand the UFPLS strategy, how to layer your allowances, and why the order that you draw from your accounts matters. But all of this assumes you know what you need to spend, and that's the piece most people are missing. Because if you don't know your number, you can't design an income plan. You're just guessing. In my next video, I'm going to show you how to build a retirement income plan. One that maps out your spending, stress tests it against different scenarios, and tells you whether your money is going to last. It's the exercise that ties this whole series together. Click it now, it's on screen.